Okay. Thanks to everybody for joining us. So today we're discussing a topic that's gaining more and more attention in the financial ecosystem, which is the blurring of public and private credit markets. There's no shortage of coverage on this topic. We've seen massive influx of capital into the private credit asset class, and more recently, the blurring of um, a desire for liquidity in what has traditionally been an illiquid market, excuse me. So regulation, access, and standardization are all being discussed in greater frequency as well. So today we'll plan to cover the increasing complexity of lending relationships, the implications of that complexity, and the impact that technology can have on that landscape. So discussing this with us are two fintech operators, Jeremy Shui and Jacob Grata. So Jeremy is the founder and CEO of Finley. Prior to Finley, Jeremy was a credit investor at Goldman Sachs, and he started Finley with the mission of building software that he wishes he had in that prior life. And Jacob is also a fintech operator, and he was previously the leader of Moody's banking software, professional services, and education units. So why don't we go ahead and jump right into it? Um, what you'll see here is the return profile of private credit relative to other asset classes on the left, along with the broader spectrum of public and private credit assets, and perhaps the blurring of those two. So, Jeremy, why don't we go ahead and start off with you? As the space has grown, how are you seeing the types of participants in credit markets change? And what changes have those new participants brought with them?
Hey Nick, thanks for having us today, and very excited to dive into the world of private credit and bank non-bank relationships in a space that's becoming more competitive and also more fragmented at the same time. So I want to say maybe 15, 20 years ago, post financial crisis, it was really just banks doing the lending, and then fast forward to 5, 10 years ago, private credit was starting to take the scenes. But what's really interesting today is uh, these banks, maybe the Wells Fargos, PNCs of the world, and the non-banks, call it the Centerbridge, Apollos of the world, are actually starting to partner in all sorts of different fashions. So you see the banks and non-banks striking up JVs. You see maybe banks passing on deals that they can't do as a lead source to non-banks so that they can retain at least their relationship with these counterparties. Or maybe you just see banks investing or buying kind of private funds outright as vehicles. So I think what used to be a world of just bank lending versus kind of non-bank lending it looks really different today, as you hear all the time of banks launching their own private funds or you know private credit funds purchasing loans off the balance sheets of banks. So we'll get into the why and what this means for private credit the next 5, 10 years, the rest of this presentation.
Awesome. Yeah. And Jacob, how is this different or maybe similar relative to previous trends that you've seen in the past across asset classes?
Uh, yeah, there's always a lot we can learn from the past, Nick. So that's a good question. Fundamentally, I like to just kind of take a step back and, to paraphrase James Carville, it's about the customers, stupid, right? Um, so what do the borrowers want, right? And are they getting what they want out of this ecosystem, or why is it happening, right? And I don't want to put them all in the same box, but I don't think they're coming into this saying, "Gosh, I want to build a new relationship with another lender" or something along those lines. It's about access to capital, it's about the terms of credit, and frankly, it is about the relationship. So, you know, in the end, are we seeing access to capital and access to credit expanding? I think um, you might look at certain parts of that market where it's, you're replacing syndicated loan lending, and that might be, moving from one place to another. But as you move down in the credit pyramid, you do see banks that have regulatory capital constraints are not able to do loans, and loans are getting done out of the private credit markets. And generally, I would say overall, that's a good thing, right? Alternate funding is going to create a better outcome for those clients, right? There's plenty to be careful about, right? How do you get these borrowers what they want without their world getting to be more complex? And that's, if I look at the market overall, that's the challenge. Is you don't want your client's life to be made more challenging just because your life as a financial system provider is, right? And you might argue that in the game theory sense, this is co-opetition, just not really a word I love, but that's what it is. And it's not competition. If you can get it to be where everyone is doing what they do best, we'll end up in a much better situation for those customers. So that's where I take it from. I think historically there's a lot to learn, and we can go into that, but I guess I would just kind of start with thinking there, which is, what is it that we do best, and what does each group do best, and how do they work together to kind of make that outcome better for the customer overall?
Yeah, absolutely. I think that's a good segue to what we have on the next slide here, which is just thinking through the advent of more participants in the broader credit landscape. And I think what you hinted at there, Jacob, is some of the pros of more participants in the space, multi-party lending. So you hit on a couple of them, maybe more liquidity, more options for borrowers. Digging a little deeper on that and your line of what does the customer want? What would you say are some of the pros for the borrowers specifically as you think about the changes in the credit landscape?
Right. So, the obvious, like you said, access to capital. That's Nick. That's important. If I can't get a loan before and I can now, and assuming let's just assume for the sake of argument, someone credible has actually given me the loan, then I'm deserving of that capital, and I'm going to deal with it. But and that's natural, right? Banks and credit funds are going to have different risk appetites, and they have different regulatory constraints, and so those are kind of going to shape the market a little bit. I think another layer down is going back to that relationship question. And if I'm a borrower, and depending on how many bank relationships I have, is adding another relationship going to be something I want, or is it best suited, and Jeremy touched on this, the partnership concept, where if I'm a banker and I can't do a loan, I can maybe introduce you to a partner, or I can actually help use some of my processes to get that partner comfortable or able to do a deal more quickly, right? Banks have pretty good infrastructure around credit assessment, underwriting, and on the back end, on servicing and on workouts and things along those lines. Is that something that is necessary for a fund to build out, or can a fund and a bank lean on each other in those ways, right? And that's a bit of an operational question, but I think to the client that matters as well, because in the end, if something, hopefully nothing bad happens, but if something bad happens, they would rather deal with one party, right? And even in the future, when they're coming to get other products, they would rather deal with, as a company, someone who's run a company before, I'd rather deal with fewer bankers than more, right? Or fewer financial institutions than more. I'm busy running a business. And ultimately, I think that's kind of important, right? You're going to get better liquidity, better pricing through competition, better outcomes in that sense, but you have to also reduce the friction for them. And I think reducing the friction is an important part going into it, because anytime we add complexity, we actually create, exponential growth in the amount of friction in the system as opposed to linear growth, and need to make sure that that's clear. So, Jeremy, I suppose that's something you you know quite a bit about, right?
Yeah, thanks, Jake. Yeah, I think you framed it really well. It's why, like peeling it back the onion, why are banks and non-banks partnering? What are they good at? And then what is the kind of differentiated offering that gets out to borrowers from this kind of, what was it, co-opetition? I like that a lot. And then what we hear from banks a lot as let's use mid-size and regional banks for this example is uh, they're very good at maintaining long-term relationships with their clients, whether that's through banking, through loans, pretty much knowing everyone in a certain geography and having a multi-decade, multi-generational relationship with them. Where banks might not be as strong are tailoring really specific credit solutions and products that borrowers in the age of putting the borrower first might demand in order to be competitive. And so I think one of the most common stories we hear that maybe tells the kind of illustrates this theme is banks want to retain relationships with the private companies, families, geos that they've kind of owned for so long. But maybe they don't have the balance sheet or the flexible credit box that a private credit fund might have. And so they'll work together. The banks, they'll retain the servicing, they'll retain the deposits, then the credit funds will come in and really just partner and offer that specific loan that might be not as conducive for a bank to offer in this age where credit risk and diversification are really important for banks.
Question from the group here. Do you see that co-opetition that you guys are both referencing as a moment in time type dynamic, or do you see that withstanding changes or withstanding, call it this broader credit cycle, and this is sort of the new age of credit as more participants co-opetition dynamic?
Great question. I can take a first step.
Okay, go ahead, Jeremy.
Yeah. So again, repeating the question, is co-opetition sustainable? Is this the new norm, or is this like a moment in time thing? I think it's TBD what kind of long-term co-opetition might look like. There's a lot of experimentation right now for banks and non-banks. Like I mentioned, maybe it's just a relationship where they pass on loans that fall outside the credit box. You see this for a Wells Fargo and a Centerbridge. Maybe they're actually standing up, insurance company or a credit fund are actually standing up a joint venture and in a 10, 15, 20-year investing vehicle together. I think my own take is a lot of these more experimental partnerships will probably fall away in 10, 20 years as there are different priorities around cost of capital or what the market wants. But it is a really interesting moment in time where there's like 10 different ways to partner together and extend the same loan if you're a bank, if you're like a bank and a credit fund. But I'd love your take too, Jake.
Yeah, I mean, the answer to that question, or the way you should answer that question, kind of probably depends on whether or not you believe that credit funds are going to be here, Jeremy, as you kind of were alluding to, 20 years, 40 years from now, right? I mean, I don't really like putting things into too simple of terms, but basically, if I think about it, you have fast capital and you have slow capital. And banks are slow capital and funds are fast capital, and they both have a purpose in the financial system. Funds are great. They move and they are efficient at moving, money where it needs to go and where it's going to be most productive, overall in the system. And right now they're getting good returns from credit lending, but that may change due to, again, capital constraints might come down on banks. There might be better opportunities elsewhere. And So should those funds be building out all this infrastructure, right? Or should they be a vehicle for, banks which are slow capital and, again, funds are lending because it's the best available opportunity for them. Banks are lending because that's what they do, right? They don't do other stuff. And so the banks are going to be there for the long term. They're going to be there. They're going to be as you said, the relationships that are the opportunities in the long haul. And, so if you believe that in that paradigm that, I don't know if I want to count on credit funds being there for, 5, 10, 20 years for me to build those relationships with, then the co-opetition becomes necessary, right? And everyone has different tenors, and this is why it's hard to kind of put everyone in the same box, but everyone has different tenors of the problem that they're dealing with. And so, I've met with business owners who have very acute needs that can only be dealt with by private capital, and they're not really building out more relationships with banks, and they'll build a stronger relationship with a private lender. But I've also met many people on the other side of that, right? So, in short, there's a yes and no, but I think I kind of lean towards the I don't trust that this is a long-term change. When I say long-term, I mean generational secular change in the market. I trust that it's important and it's going to be there for a while, but it may not be there permanently, right? Um, you know, just to add one more thing, I lived through the great financial crisis, right? I was in the structured finance market, leading a structured finance business, you know. Um, so Mark Twain supposedly said history doesn't repeat itself, but it rhymes. I don't know if he really did, but you know, there's similar stuff here, right? We had back then, and these are risks. You had origination and you had risk taking divorce from one another. You had, complex structures. You had, importantly, you had a lot of lack of transparency in terms of holdings and the health of the borrowers and the health of the sponsors, right? A lot of sponsors back then went out of business. And I wouldn't expect us to walk off the same cliff. There's a lot of mitigants that have been built in. It's a very different market. It's not anywhere near as dangerous probably, but just as examples, and Jeremy, I think you've probably solved this problem, but in 2009, I was working on a lot of securitization, helping people value what they held. Went to Europe to visit a bank, and they literally gave me and one of my colleagues 2 boxes of paper because they had faxes on all of the documents and on the holdings in their securitizations and nothing else, right? Um, that was not a good sign for the market, right? And I think today it should be better, right? So this is why I'm kind of like, I'm not, a naysayer on this, but when bad situations arise or when people want to get out of the market, and there was a lot of, at the time, fast money, as I call it, in securitization in 2006 and 2007 that was not there in 2009, right? And we had the ultimate fast money come in, which was the government, or slow money, whichever you want it to be. You want to know who you're dealing with, right? And I think that's why the co-opetition question is important, because I think you want to know that there's going to be a partner there for you if you're a borrower.
Definitely. Yeah, no, it's perhaps we've come a long ways since that plane trip in 2006, 2007, but to your point, a lot of history rhymes. And I think that's a good segue to our next sort of discussion point, which is, Jacob, you've seen how these markets and the technology that underlies these markets have changed in the past, especially when you think about evolving to meet the needs of both funds and banks. So as you look at the market today and you look at the state of technology and um, what's needed, How is this similar or different to what you've seen in the past?
Um, you know, that's a good question, Nick. You can't put it all into one box, right? I mean, the private credit market, is got $500 million lines that effectively would have been a public debt beforehand. And you've got SME lending and on the other side and everything in between. Um, so I don't think you can recreate the wheel here, right? If you just harken back to CLOs, and they're still around, but when I used to work with them, you would have requirements on, you know, public credit ratings from Moody's and S&P and Fitch and things along those lines. There's a lot more NRSROs today, right? And I know there's a lot of criticism of the smaller NRSROs. They probably play a role in these smaller deals, right? Um, I don't think the same methodology that you get from one of the big three, and they may offer a different methodology for small credits. I don't know in the future. I'm not commenting on that, but that's not gonna fly for the smaller deals, right? So you kind of have to think about this in terms of what works and what's sensible, and not put it all into one box. Um, my general mantra would be use what works, build what's missing. And there's a lot of stuff in the market that already works, right? So, for large credits, credit ratings work. There's standardized documentation. There are secondary markets, and I think, secondary markets can be um, filled by investment banks or by some of the very large funds that have, huge amounts of capital. Um, but, don't force that infrastructure on things that are more relationship banking oriented, right? Um, and so, you know, if you follow that mantra that there's, again, build what's missing and use what's working, then you can really focus on integrating and um, then taking in what your bank or what your institution needs that doesn't already exist, and leveraging other people for it. So, um, the winners are going to be those who, do smart specialization. I don't think we need, convergence theater for the sake of convergence. So,
Yeah, absolutely. I like that framework of use what works and build what's missing. Jeremy, as you think about the what's missing piece, especially in the context of the change that we've seen in the credit markets, what should participants in the credit markets be prepared for, especially in the context of what you think is missing from an underlying infrastructure perspective?
Yeah, this kind of alludes to what Jacob was talking about earlier around fast money versus slow money versus uh, maybe controls around, I'll use a new term, exiting money when kind of things don't go as planned. And so I think so much the innovation is probably around enabling more fast money to come into the system. You hear that with talks around kind of promoting liquidity, promoting syndication, enabling front offices to partner maybe with uh, kind of more non-bank players like the endowments and pensions of the world that might want to raise allocation to private credit at this moment in time. But we don't hear as much uh, about, call it, controls and kind of technology to protect the pretty wide range of counterparties. And so what I mean by that is, today, if you're a private credit fund and a loan goes bad, I think it's pretty clear how you might, invoke some of the protections, the restrictions, the foreclosing on collateral and borrowers. But if you are a pretty new participant to the world of private credit, which is just getting more and more complex, and you're an insurance company and not a bank that's had to deal with defaults before, I think there's probably a lagging wave of technology and infrastructure where, uh, you know, if they have really unique needs and they have to work out and restructure loans, they definitely don't have the tools to kind of keep up today. Or if the answer is, hey, we should just really rely on the restructuring and the workout tools of banks, that could pose an answer as well. But yeah, in today's tooling, we see so much emphasis on, hey, it's just liquidity at all costs, call it. But on the other side of that equation, if, you know, money exits the systems or there is a wave of defaults like '08, uh, what are the, who's investing in those tools that are kind of like, yeah, servicing, or I like to think of it as special servicing that we might all need someday.
Yeah, Jeremy, I like that point that, you know, allocating capital is the easier part, right? It's dealing with challenges and dealing with it for the next 10 years. That's the harder part, right? Um, just to go back to, the past, um, leading into the great financial crisis, we had customers in, the CLO space where you could see how much they were spending on their monitoring and servicing tools and things like that, right? And spending a few basis points, it sounds almost laughable to spend, that you're only spending a few basis points on servicing or monitoring your portfolio. But there was a marked difference between those who survived and those didn't, based on what they spent on just managing and understanding the portfolios they had. And there were some very successful stories out of that. There are obviously some very bad stories out of that. Um, and it's that long tail that you're getting into in this market that you have to be prepared for, right? No one sees that you're going to be for 10 years dealing with a diminishing revenue stream on every loan that you originate, and potentially an expense stream, hopefully not. And that's where that investment in technology kind of matters, because that's where you're going to actually avoid and then manage the cost stream a lot better.
Yeah, I couldn't agree more. I think so much of today is, people are promoting how big the private credit funds are, or how many deals they did, or how high the allocation is. Versus, I think back to my time in private credit at Goldman Sachs, and we would brag about our first lien recovery rates like being 70 to 75% and higher than the industry standards, uh, uh, or what our tech and our process, the kind of the alpha was just how much better your recovery rates and your ability to kind of execute when things don't go as planned were. So quite a different paradigm, and probably just a conversation that needs to be happening more at these kind of first time private credit allocators.
Yeah. I guess just, if I were to sum up a lot of those points that I feel like, I don't know, maybe we agree on, it's a little bit, there's a convergence that's really necessary out of this whole who's good at what part, but there should still be a differentiation, because that's specialization. That's natural, right? And I don't really want to get in the game of predicting will more or less money end up in X market or Y market. It's obvious that today the private credit markets are growing pretty quickly and have done really well, and they probably will for the near term. But we should expect them to be more volatile. It's just kind of a natural part of it. And if that's the right spot for a borrower, that's the right spot for a borrower. And I think the financial institutions have to figure out how to make it borrower friendly to get what the borrowers need.
Yep, absolutely. Lots of changes, no doubt, especially as you think about this fast money, slow money, the changing needs of borrowers and lenders. Um, but plenty to digest and plenty to take back for us. So we thank you, Jeremy and Jacob, for joining us today. Lots of great insights and things that we'll keep top of mind as we navigate the changes of the broader credit landscape and importantly, the role that technology plays in those changes. So thank you both. We really appreciate the insights.
Thanks for hosting, Nick, and thanks for joining us,
Yeah.
Jake.
Okay.
Thank you, Jeremy.
Thank you. Bye.
Bye, guys.